Hi, everyone. Today's Real Vision Daily Briefing is sponsored by Crane Shares. Learn about their KCCA ETF at craneshares.com/KCCA/Real Vision. Now to the top analysis of today's markets.
Welcome to the Real Vision Daily Briefing. It's Monday, October 9, 2023. I'm Ash Bennington. War in the Middle East, horrific weekend, obviously. Our remit, of course, is to talk about its impact on markets. Jared, Dillian, what do you see happening in markets right now?
Well, I was sitting on the couch last night and I logged into my Bloomberg app just kind of see where everything was. And stocks were down about 30, 35 handles. Bonds were up, gold was up, pretty much what you'd expect. And you had a lot of follow through today because we had 12 Fed speakers that were pretty much all saying the same thing. And they were saying that long rates have basically done the tightening work for them. So there was no need to tighten short rates. So we had a big squeeze in stocks, and twos went up a lot and gold went up and even more. So, yeah, that's kind of the backdrop.
So, Jared, obviously, we see on the screen right now a lot of green, up fractionally. I mean, I think all the major indices are up a little bit less than 1%. Dow Jones Industrial Average, S&P 500, NASDAQ, Composite, all hovering between, call it up 0.5% and 0.75%. So lightly positive across the board. What do you make on that from stocks?
I mean, I think if the layperson were to look at where stocks ended today, they'd say, gosh, that doesn't make any sense. I mean, we have basically the biggest war in the Middle East in history, and stocks are up. That doesn't make any sense. But really, the squeeze started to happen. I forget which Fed speaker it was, maybe Jefferson. But it was when we had the Fed speakers that's when stocks started to squeeze. And if you believe that we've had our last rate hike, which I think we have, I don't think we're going to hike in November. And if you believe that usually we start cutting within 6 or 7 months of the last rate hike, then yeah, I mean, that perfectly explains stocks being, up 1% on a big reversal. That makes sense to me.
Yeah. You mentioned to your treasuries. Tell us what you see there trading right now on a yield basis. Looks like 5.08. We saw obviously.
Well, so the bond market is closed today. So the bond market's closed because of Columbus Day. So really what's trading are futures. So I don't know where twos are in yield terms, but I can tell you that futures are up 9 basically today. The futures are up 9 plus, which is a big move in 2-year note futures. So yeah, I mean, I think the bond was up like a point and a half or something like that. Like it was a big move in treasuries, but we'll see what happens tomorrow when cash bonds start opening up again.
Hey, let's talk about this, the mechanics of what happens when you have bond markets closed, but futures markets trading. Obviously, we're talking here about what's happening in futures markets implied on rates. What does that mean, and why is there a divide or a disconnect between what happens when cash bond markets open relative to what's happening in the derivatives positions?
Well, it's not even just the derivatives, it's also the ETFs. Like TLT, for example, like everybody knows TLT. Like TLT is basically trading on expectations of where the bond market is going to open up tomorrow. Like if you're a market maker in TLT and you're trading TLT, like you have no means to hedge with cash bonds. Like you can
Right.
hedge with bond futures, but it's not a great hedge. So liquidity in TLT and the other bond ETFs is down on a day like today, but it's basically like it's signaling where bonds are going to open tonight, basically.
So why would you see a differential between what would happen in the cash market and what would happen on a proxy, whether it's on the derivative side or on the ETF side? In other words, why wouldn't those align? Is it just a question of liquidity and pricing?
Yeah, it's just liquidity and pricing. That's it. Yeah.
Yeah, TLT on my screen. I'm trying to get this. Looks like after hours. It looks like it's up on the close about 2%, which implies bond yields down.
Yep. Yep.
Yeah. All right.
I
Let's
have
talk.
I have some I can't tell them on the air, but I have some hilarious stories of trading ETFs at Lehman, like trading the bond ETFs when the bond market is closed, and like with like equity guys like not understanding that, and it would just, hilarity ensues. So, yeah.
What happens? How do those markets get dislocated?
Well, I mean, this was back in the mid 2000s. So, I think that, we have a lot of quantitative trading outfits today. And I think there are some algos that will trade TLT against bond futures and stuff like that. But back then that didn't exist. So literally like the price of TLT was driven entirely by supply and demand of TLT. Like
Right.
it could go way out of whack from where yields are supposed to be. So
So now what you're saying is essentially the quants arbitrage those differentials away to try and bring them into alignment. So lower opportunity to profit from those
yeah,
dislocations.
yeah, yeah.
Yeah. All right, let's talk about another thing that people are talking about here, which of course is oil. WTI on my screen, 86 spot 40, up about call it 4.33% on the day.
Yeah, I kind of want to talk about the conflict in general terms and kind of what this means for all asset classes, including oil. Like, I am of the personal belief that this is going to get much, much worse. And it opens up a whole new set of risks that it turns into a regional conflict, that Israel attacks Iran, that the US attacks Iran, that this turns into a prolonged war that, I mean, there's a lot of times when you have some exogenous event that happens and markets move and people don't really know what to do, they don't know how to process it, but they don't really look ahead. And when I look at the VIX at 18 today, I think it opened up around 19 and a half or 20. Like that is completely mispriced. That is completely mispriced. I mean, if you think about the purpose of a tail risk hedge fund, like, and what that's designed to do, it is designed for moments like this. A tail risk hedge fund buys calls and bonds. They buy calls on VIX. They buy calls on oil. They buy calls on gold, and they buy puts on the S&P. And they just wait for things to blow up. And the whole philosophy behind a tail risk hedge fund is that these exogenous events happen much more often than probability dictates. So you have these long periods of time where you're bleeding money, you're bleeding decay, and then you have this exogenous event. And look, if you're of the mind that the worst is over, that this is going to be contained, that we're not going to have any kind of contagion, then sure, go back to selling bonds, sell oil, sell gold, do all that stuff. I don't think that's the case. I don't think that's the case at all. I think this opened up a big can of worms.
So why do we see then this relatively modest move on the VIX, trading on my screen 17.6 right now? I mean, this is
Well,
not
a lot the way the VIX is calculated, the VIX is actually not a great index. It's very spot dependent. And what I mean by that is if stocks go up, the VIX will go down. Like in the calculation of VIX is a measure of spot. So like it's spot dependent. So like if stocks go up, the VIX goes down. Um, Having said that, like I did not see today a demand for volatility. I did not see anybody buying 50,000 out of the money S&P puts. I did not see, bond markets closed, but I didn't see anything going up in futures. Like I think people are complacent.
so what's the opportunity then based on what you see?
The opportunity is in all those asset classes like I mentioned. Like I think you really have to think like a tail risk hedge fund, and this is sort of the opening salvo of what could be a much longer prolonged conflict that could spread into places you don't want it to spread. So yeah, you would buy bonds, you would buy gold, you would buy oil, you would sell stocks.
So let me ask you this: of those menu of alternatives that you mentioned there that look like tail risk hedge fund options, what do you see as being the most opportunistic right now for you, and how are you thinking about it?
Absolutely the front end of the yield curve. I've been beating this drum on the daily briefings for a couple of months now. I personally have built up a large position in 2-year note futures. Um, Interesting looking chart. I recommend you check it out, of twos. Like basically throughout all this bond market madness where the long end was selling off relentlessly, the front end was pretty much anchored. And now you're getting the Fed communicating that we've had our last rate hike and we have a war, which could threaten global trade, oil prices, stuff like that. Like the next move is going to be a cut, and it's going to be lots of cuts. That I am pretty sure of.
So where do you see this going on a yield basis, and how bullish are you?
Um, so twos are at 5% right now. Probably go to three at a minimum, maybe 2.5.
That's a huge move. You're talking about
Yeah,
250
yeah,
basis points
yeah,
here.
yep.
And how are you playing that on the future side?
I'm just long. Yep.
Yeah. I also want to show a clip from a conversation here on Real Vision. Andreas Steno Larson talking about American exceptionalism more broadly and geopolitics in the energy market. Let's take a look at that clip right now.
What I like about the current setup in energy is that I think there is a fundamental reason to expect the oil rally to resume due to flawed data last week on the gasoline consumption. And if you then pair that with the geopolitical risk, then you have a cocktail pulling you in the same direction, right? So I add the geopolitical layer to an already fundamental macro layer. I will never trade geopolitics on a standalone basis. So had the fundamental outlook been different in oil, then I would never have used this geopolitical excuse to re-enter a position.
Andreas Steno Larson, obviously talking about a potential rally there in oil on geopolitics and on some fundamental factors that he sees. Jared, you talked about your setup for 2-year notes. Let's talk a little bit about the energy complex and oil in particular. We mentioned WTI earlier in the show. What are your thoughts? Are you as bullish there as you are in bonds as another hedge?
Uh, I am bullish. Like, I mean, let me put it this way. Last week I was bearish. Sentiment is all over the place. Sentiment is kind of a mess. One thing, I'm not an oil trader. Oil trading is confusing to me. This was like 3 or 4 years ago, there was something that happened in Iran and oil futures spiked on a geopolitical event, and that ended up being the high. And then it traded off relentlessly for months. So, kind of the prevailing wisdom in the oil community is that you want to sell these geopolitical events. And I'm not a part of that community, and I see the potential for something a lot worse. And I kind of want to buy the geopolitical event, but this isn't really my bailiwick.
Mhm. Fair enough. Jared, we got a bunch of questions coming in hot right now, and I'd love to get some to you because this is an interesting one. Trillion X Macro on YouTube wants to know, Jared, did the equity melt up just start?
No, I don't think so. I don't really, I don't have a position in stocks at the moment. I was short for a while and I covered. Um, I do think that I think the analog here is 2000 and 2007. Typically, rate hikes, the end of rate hikes co-occurs with the top of the stock market. It happened in 2000. It happened in 2007. Um, on the way down, when you get the rate cuts, you see these big rallies in stocks, but those are all rallies that should be faded. I guess I'm leaning bearish, but like I said, I don't have a position right now. So
Yeah. Yeah, I was going to say that does certainly sound like a bearish lean. By the way, you can see the logic in the question here, right? Which is, if you think that the Fed is going to start cutting, are we going to see a kind of symmetric asset reflation against the loosening of monetary policy more generally?
yeah, honestly, I'd be looking for another place to short. You know what I mean? So we topped out around 4,600. We traded down to about 4,240. We're at about 4,340 right now. I think you get stocks up to 4,400, 4,450. That's probably be where I'd like to lay out another short. So
Interesting. So you're going to start to see this environment where stocks and bonds start moving in different directions again.
it that should happen. It's funny. I was thinking about that last night. When I checked my Bloomberg app, like, in times of crisis like this, because bonds are many things, and right now we have too many bonds. But bonds always are a safe haven asset. You know what I mean? And actually, I want to dive into this a little bit more because this is kind of like a pet peeve of mine. So, all the bearish rates people have been talking about supply for months, all the issuance, all the supply. And the thing about supply is that you can very easily measure supply. We know exactly what the government is issuing. We know how big the auctions are going to be. And we also know how much China is selling and we know how much Japan is selling. So you can figure out supply. Demand, you have no freaking idea. You have no idea if demand will rise to meet supply. And what I've said on other daily briefings is that, look, like you can't predict what is going to turn bonds into a safe haven asset again. Back in 2008, 2009, when we were running equally large deficits, like people were super bearish on rates. They were buying these CMS caps on rates. People thought rates would go to like 4 or 5%, and it didn't happen. People showed up at the auctions. We had these huge auctions, 60, $80 billion worth of tens, and people showed up, and the bid to cover was like 3. Like there was massive demand because the stock market was melting down and people wanted bonds as a safe haven asset. Could happen again this time.
That's such a good point, Jared. And, we've heard so much about the 60/40 portfolio being dead. We've heard all of this sort of secular bearishness on the bond market. But you make this point in the times of geopolitical crisis, if there is just a bid for safe haven assets, you could, in fact, see exactly that. You could see a meltdown in equities, theoretically, where a flight to quality happens in U.S. Treasuries.
Yeah, I think it's going to happen. I do.
Yeah, well, that's the case. Is this it on YouTube? Can we get Jared's sentiment analysis on gold? It was pretty bad before this conflict occurred. Great question.
So, have you heard of the literary device called Deus Ex Machina,
I sure have.
God from the Machine? So, basically, Deus Ex Machina in a story or a novel is when everything's going really, really bad, and then some exogenous event happens and like bails everybody out at the end, and you have a happy ending, right? So, it's a terrible device. It's not a good way to write a story. This is what I call diabolus ex machina, right? Something really bad happened that bailed people out of these losing trades, including me, right? My two biggest positions were bonds and gold, and I was getting crushed, right? And this exogenous event happened and it bailed me out. The funny thing about these exogenous events is that they always seem to happen right at the moment that the market is at maximum stress. Maximum stress.
Interesting. Here's a question from Simon Wickberg on YouTube. Do we see oil going to $100 a barrel on the new escalation?
Yeah, it could happen. I don't know. I don't have a strong opinion. I think it's probably going to go higher, but um, like if we have an all-out war in the Middle East, I think 100 is a given. I think 120 is a given. You know what I mean? If this gets much worse over the course of weeks.
Yeah. Here's Trillion X playing devil's advocate on the last question. It's an interesting one. If inflation rises because of another war, you don't want to be in bonds, right? So he's talking about this differential in rates potentially seeing inflation wipe out those yields as they drop, particularly, I would assume.
Well, not necessarily. Like I'm trying to think of what the bond market did in World War II. Um, I think the government was able to issue bonds at pretty attractive yields. There's all kinds of weird stuff that happens during war. Like just for an example, during World War II, we had war bonds, and the government had this huge marketing campaign to get people to buy bonds, and people bought bonds in support of the war effort. So the government was able to finance that war basically internally. So like I don't think you can say that, okay, we're going to get inflation during a war and that's going to destroy the like I don't I think some of those relationships kind of break down.
Yeah, Jared, you've made some very nuanced points here about these markets. But if I had to sum up what we've talked about in the last 20 minutes, I could say one of the overarching themes here that you've started to unpack is that in times of geopolitical crisis, all bets are off. You could see a significant reversal of some of the longer term durable correlations that we've seen and some of the the sort of truths that we assume to be the case may not be. Is that fair to say that you could see just a major reversal of a lot of these broader trends?
Yeah, it's not even really like a reversal of trends. It's like a regime shift. You know what I mean? Like basically the thing that gets people in trouble in markets is correlations, right? Because you have these periods of time where correlations are stable and then something happens and the correlations are unstable and the relationship between all the asset classes changes. That's how people get murdered in markets is when the correlations break down. And I think I mean today is T equals one. But, I think today was an example of that.
Here's one from TC. Question for Jared. Does he think TLT is being used in ARB with futures? If you look at the call OI, open interest, it's bonkers, and I don't see another explanation. So he's seeing the size of the open interest gap up and asking the question about, is this an arbitrage opportunity in terms of the relationship of TLT to the cash bond market?
No, I don't think so. I mean, the AUM of TLT, I want to say is like 40 or 60 billion or something like that. And the open interest in treasuries is hundreds of billions. So I don't think that's and plus, like, having traded TLT against bond futures, like the duration of bond futures is very short. The duration of TLT is very long. It's a terrible hedge. Like, I don't think that's happening. So
There really are a lot of terrible hedges in terms of the bleed out on, attempting to compensate yourself for the risk that you see in the future and the price you pay in the present.
yeah, yeah. Yeah, for
I
sure.
mean, we're talking about that with VIX as well.
Yeah, yeah.
Is there any way to capitalize on VIX mispricing?
I don't trade VIX. It's my belief that the only people who make money in VIX are the VIX market makers. You know what I mean? Um, every time I think about like every time I think about trading VIX, I just want to tase myself because I look at the VIX options and I'm like, oh, I should buy like the 40 calls, and well, they're too expensive. I'm like, oh, I should sell the puts. Well, they're worth 10 cents. Like it's like I got to tell you, like when VIX options first started trading in like 2006, there were huge opportunities, and now it's all perfectly priced. So
Yeah, I guess that's a broader theme we could talk about in markets. So you mentioned earlier you didn't have a strong conviction around any particular number on oil. Do you see anything there in terms of resistance or support levels, or do you just feel like this is a broader secular trend higher based on geopolitics, and you're not really sort of in the weeds in terms of the price action based on the futures markets?
Uh, I mean, if the most recent high was up around 92, so you probably have resistance there. Um, and above that, you don't really have resistance until 120. So, just from a technical standpoint, I mean, those would be your resistance levels, and support would be around 68, I think. So,
Got a long way to go to the upside then.
yeah, yeah.
Jared, what are you thinking about in terms of the macroeconomic variables around employment and inflation?
Um, I wish I had an answer. What's interesting is that we were operating under the assumption that the Fed would not pause rate hikes or the Fed would not pause rate hikes until we had some kind of uptick in unemployment, right? And yet we never got an uptick in unemployment, and now the Fed is pausing rate hikes, right? So, like getting back to correlations breaking down, weird stuff
Right.
happening, like that's kind of an example of it. Um, you know, I I don't really have an axe to say that there's going to be layoffs, that unemployment is go up. I'm not really sure. Like, I think that economic activity is slowing down. I think we're headed into a recession. Um, Usually, when you have recessions, unemployment goes up. Hasn't happened yet, and I don't think I have an explanation for it. Just like anybody else.
Well, here's a topic we haven't hit on coming from us from Steve. Jared, do you have a view on USD? DXY, I should say, US dollar index over 106 right now on my screen.
Yeah, I got to look over at it at my screen. Yeah, the dollar's up as a result of this, um, which is yet another example of correlations breaking down because the dollar's up and bonds are up and gold is up. Yeah, I mean, the dollar should get strong if this conflict continues, then dollar should get stronger, absolutely. But I don't really have a strong opinion on that.
SBD 758 from YouTube. What does Jared think about industrial metals like aluminum, copper, etc.? These are all quite cheap, but are we going to sit here and go lower until rate cuts?
I got to tell you, so typically the industrial metals, all metals, but industrial metals in particular, start to do really, really well during a rate cutting cycle. And also, industrial metals do really, really well in times of war, right? So, this is actually an interesting comment, and it's funny because I hadn't thought about this, but it was funny. I pulled up the chart of Alcoa last week. It's a horror show. Like, it's a terrible chart. The stock is down like 60, 70% from the highs. Like, if you think we're heading into an easing cycle and you think we're heading into war, man, that's an opportunity for sure. I totally agree with that.
Any base metals in particular or commodities that you see being particularly well positioned to benefit?
I mean, copper, aluminum, tin, lead, all that type of stuff. Yeah, for sure.
So it's basically everything across the board.
Yep. Yep.
Yeah. Jared, anything I've missed? What else are you thinking about? What else are you interested in right now? What's got your attention?
Gosh, I think we covered everything. Yeah, I mean, it would be, it's funny. I think I might actually tune into the daily briefings the rest of this week and see what people say about what they think what's going to happen with the war and stuff. I'm very pessimistic. It's, I'm actually, it's very hard to watch. It's very hard to watch, and it's affected me personally. And it's a really tough time. And my heart goes out to all the Israelis, and it's really bad. So.
Yeah, obviously a very difficult time, and it's difficult to come on here and talk about markets when you see such terrible things happening in the world. But that's our remit. That's what we're here to do, and to understand this because obviously there are price implications. Jared, we covered a lot of ground here today. Currencies, commodities, I guess, stocks, bonds. It's been a broad conversation. Final thoughts, key takeaways that you'd like to leave our viewers with.
Well, I would say that, we were kind of waiting for the turn in rates. I think the turn has happened. It's funny, it happened on a day that the bond market is closed, but it happened. I spent a lot of today looking at charts, and it kind of seems like we made the turn. So, the next 100 basis points in rates is definitely down, not up, for sure.
Yeah, let me ask you this. You're talking about the short end of the curve here. What do you see on the 10-year?
Same. I don't really have an opinion on sort of any yield curve transformations at this point. It should get steeper. If we start pricing in cuts, you're going to see 2-year yields go down dramatically, but it could be a parallel shift in the curve. So, but it's not going to be a flattening. Let's put it that way. It's not going to be a flattening.
So the likely case is steepening as the long end remains
Yeah.
high. Yeah, Jared Dillian, always a pleasure. Great to have you here, especially when there are times like these to unpack everything that's happening. Thanks for joining us.
Thanks.
Thanks for joining us, everyone. Today's Real Vision Daily Briefing is sponsored by Crane Shares. Learn about their KCCA ETF at craneshares.com/KCCA/Real Vision.